quarter results briefing. Thank you for taking your time out to attend this session. I'll first start with the market context and then go on to talk about our performance. Market has witnessed a slowdown in the quarter, predominantly led by rural. Rural, which used to grow about 1.34 times urban, has more recently been growing only about 0.5x of urban. During this quarter, we have also had various disruptions, given rains on one side or liquidity challenges other in the broader market. Crude price and currency have continued to remain volatile due to global economic cycles and trade dynamics. In this quarter, the government and the Reserve Bank of India have announced several measures to spur investment and boost liquidity, including reduction to the repo rates and corporate taxes. We welcome these policy announcements and are confident that the government will take necessary steps for higher income transference to the rural India. Against this challenging market backdrop, HUL has delivered a good performance in September quarter 2019. Our domestic consumer growth stood at 7% with underlying volumes at 5%, and this comes on the back of a strong base comparator. We have delivered an EBITDA of 2,443 crores, which is up 16%, and it's actually a 200 basis points EBITDA margin expansion on a comparable basis. Our reported EBITDA will, however, be higher at 310, given the accounting impact of IFRS 116 on leases. Our profit after tax but before exceptional items grew by 20%, and our net profit at 1,848 crores was up by 21%. Our corporate tax financial year 2019 and 20 will be around 27% as a result of the rate reduction, and this has been factored into our results. Margin expansion was driven by mix, a benign commodity, and our continuing savings agenda. Let me give you a bit of a flavor about our divisional performance. This quarter, we have delivered a steady performance across all our divisions. Home care delivered a robust growth of 10%, another quarter of double-digit growth. Our fabric wash continues to drive consistent top-line growth. And during the quarter, we've launched Love & Care, a premium expert fabric care wash brand in select channels. Our household care continued its growth momentum, driven by our focus on increasing penetration of bars in rural and liquids in urban. Domex Pick Up the Brush campaign was extended to Tamil Nadu, onboarding another superstar in South India, Kamal Hassan. Beauty and personal care grew at 4% on the back of good performance in personal products. In personal wash, as you're aware, we are taking some decisive actions to strengthen our competitive position. During the quarter, we have landed many price reductions to pass on the benefits of commodity reduction and correcting the laddering of prices across our different packs. We also refreshed our communication on the popular segment. Pierce Natural Body Wash was launched nationally after the success of its soap range, and Fair and Lovely soap continues to gained good traction. Skincare delivered double-digit growth, backed by robust performance across brands. In this quarter, we brought in a number of innovations into the market, such as Pond's Micellar Water, L18 Body Lotions, and Pond's Super Light Gel. Hair care registered steady performance across the portfolio. During the quarter, Clinic Plus was relaunched with a new campaign, Meri Beti Strong, to bolster the product proposition in our communication. Color Cosmetics sustained its strong growth trajectory with continued focus on channels of future. Oral care growth was led by freshness and naturals proposition. During the quarter, we launched close-up attraction variants in select geographies. If I look at foods and refreshments, the category delivered an 8% growth across categories, with beverages, ice creams, and foods all performing well. If I look at our first half performance, for the first half of FY 2019-20, our domestic consumer growth was at 7%, and our EBITDA growth was higher by 14%, registering a healthy 170 basis points margin improvement on a comparable basis. Net profit was up by 18%. In the current challenging environment, this is a testament to the fact that HUL is well positioned to navigate the short-term challenges as we unlock the larger FMCG opportunity in India. We continue to reward our shareholders. I'm pleased to inform you that the Board of Directors have proposed an interim dividend of rupees 11 per share, up from last year's 9 per share. So that's a 2 rupees increase to our dividend per share payout. The consistency and resilience of our performance reflects our continuous focus on four key drivers: strengthening the core, driving premiumization and market development, constantly innovating and experimenting to lead in new business models and channels, and relentless focus on execution. Looking ahead, we expect the near-term demand outlook continues to be challenging, and we expect it to remain so for some time. The policy initiatives taken by the government augur well. Income transference to the rural areas, however, will be a key imperative. Commodities and currency will continue to be volatile. So our strategic agenda continues to be one of delivering consistent, competitive, profitable, and responsible growth. We continue to progress our purpose-led and future-fit agenda, which is underpinned by our sustainability initiatives and reimagining HUL, driven by leveraging data and technology in all aspects of our operations.
So
Thank
is
you.
rural growing below urban?
0.5.
Is rural growing below urban at this point?
Can we take one at a time, please?
Is rural growing below urban at this point in time? Because last quarter you said that they're at par. Is it now gone below urban, and by how much?
That's what Srinivas said. It is growing at 0.5x the urban growth.
So when you talk about 0.5x rural to urban growth, where are the pockets that you're seeing pressure? Because there is liquidity that everyone's talking about. Also the wholesale channel. So where really are you seeing the pressure points, and how soon do you expect recovery?
When we say that rural growth is growing, first is, I think we should be absolutely clear that there is still growth in the market. It's not that the growth has disappeared. But yes, the rural growth, we expect it to be at a much higher rate for the simple reason that the penetration levels in rural India are much lower. And if we see the previous periods, whenever the growths have been good in the country in FMCG sector, rural has grown above the urban in the vicinity of 1.2 to 1.5x. So there is stress in rural, and that is the reason why the rural growth rates have come down to 0.5x. And it is broad-based, across the country. Wherever there is a larger domination of the rural markets, you see the growth rates coming down. And because wholesale feeds into the rural markets, you see the stress from the wholesale also transmitting into the rural markets. But wholesale at the end of the day is a channel. So there is some stress on liquidity, but when we talk about offtake, it is the demand from the rural, which is where it has grown down, where it has come down.
So you spoke about price cuts during the quarter, especially in the personal care. If you could give us an understanding of the kind of price cut that you've taken through the entire quarter, and going forward, do we have more scope of price cuts considering also benefit from the corporate rate tax cut?
So I think let's split into two things. First is that predominantly the reason for doing some of the price reductions in our cleansing, which is our soaps category, is because of benign commodity. If you were to compare it year on year, the vegetable oil basket is lower anywhere between 15 to 20%. And if you really look at that, at least projected into the next 6 months to 9 months, at least it's expected to remain benign. Now we will see how international factors play out. But on the fundamentals, we clearly see it remaining benign. We had said last time when we declared results, saying that, look, we had looked at somewhere between 4 to 6% a reduction in the prices in our cleansing. We implemented Lux and Lifebuoy during the quarter, and we will actually be now implementing some more further reductions, whether it's in Dove or in Pears. Therefore, the whole portfolio corrects itself given the commodity. I think that's the first piece. So approximately about 6% is the price reduction that we'll do on the total portfolio. Part of it you saw in September quarter, part of it will come into December quarter. Now, the corporate tax reduction is a completely different aspect. Predominantly, it's been done with an intention to spur investment, and I think that's the right direction. We are actually looking at all opportunities to really saying how do we use that opportunity to kickstart some investment cycle, and in due course that should lead to consumption. I think today that is work in progress.
So, but do you think as far as consumer offtake is concerned, offtake obviously has been impacted? Increased discounts or promotions or price cuts?
So I think fundamental drivers, I think one needs to go back, and I think Sanjeev talked about it. I think income transference and first income in the hands of the consumers, I think that is the most welcome step. Anything else that you do in terms of pricing, promotion, it's actually more tactical rather than strategic. We are hopeful that liquidity issues will get addressed as the government and central bank have taken many steps. We are also hoping that with many of the policy initiatives coming in, that will also work. We've always said, look, we also always want to focus on the consumer. So if we have to do something, we'd rather do everyday low prices, give the value to the consumer, and due course as some of these fundamentals fall into place, consumption will pick up. That's how we will really play this game.
Will you look at other categories as well for price cuts? Will you look at
That's why I said I go back and say, where is the commodity? So that again, let's break it up. We have seen softness in commodity, predominantly in veg oils. We have seen some softness in crude, which means that we don't have to price up. And if there are some opportunities to price down in home care, we will use those, but we'll be judicious. It has to make sense. However, when you look at, let's say, something like our foods and refreshments, there's actually inflation. Whether it's sugar, whether it's SMP, whether it is even our ketchups, I think there's a sizable amount of inflation coming through, and you'll need to balance it. And as Sanjeev has always said, we will take an overall HUL approach to handling how we look at the portfolio, and it doesn't necessarily have to be a category by category or a pack by pack.
So when you say that slowdown,
It's generally broad-based, but there are some categories where the impact would always be more severe than the other. And discretionary categories generally end up taking a larger brunt of it whenever there is a slowdown.
So when you price cut is only because of the declining commodity prices, so should we understand like this that the price cut is not because of demand? That's not the issue because of it.
Of course. So look, the point we have always said is that you have to do fundamentally the right things from a consumer lens. Today, if my commodity prices are at least 15-20% lower year on year, is it not fair that I pass that all on to the consumers? So in the categories we have seen that we've passed it on, and it's not that you can just cut your prices and you'll spur demand. It's not a one-to-one correlation. Demand is a function of many things, and as we've talked about, it's also about consumer confidence.
Okay. And the 6% price cut that you're speaking about, have you taken or total?
Parts have already come in September quarter.
So parts means how much? 4%?
Yeah, something to that effect has come in September quarter. The balance will come in December
The
quarter.
balance 2 or 3% will come.
That's right. In the cleansing category, it's not company's totality. It is our soaps business.
Okay.
That's what I'm talking about. I think it'll be just also good to focus back and saying is, I think one important element while we'll miss in all of this is the robustness and the resilience of a performance of HUL. If you really look at our numbers, a 7% USG and a 5% volume growth in this quarter is actually a very, very credible and a resilient performance. I think it's also good to remember that when environment may be challenging, but the whole aspect that we talk about, our agility, our responsiveness, our ability to keep consumers at the heart of what we do, is actually a testament to really the robustness of this organization. I think while we'll all talk about the challenging environment, I think it's also important to just step back and focusing who's best positioned to actually navigate the short term while unlocking the long term. It'll be just good to also talk about that while it's not a doomsday as Sanjeev said.
Yeah, I think we should just pause and reflect that first is that the country is still growing, albeit a bit slower, but it's still growing. Yeah, 5% GDP for a $3 trillion economy is still substantive. FMCG sector is still growing, both the volume and the value. And there are two important factors which impact the FMCG demand. Yeah, first is more money in the hands of more consumers. I think that's the critical factor. It is not about concentration of income in a few people, but more.
That was HUL management talking about their numbers, superb set of numbers, especially on the margin fronts. We'll get more details as time goes by and more details presentation come in, but the management also sounded quite confident. That's the scorecard for you. Revenue in line, margin above, volume in line with a positive bias. On that note, completely out of time, taking a break. Stay tuned.